Good morning, everyone, and welcome to Weekly Profit Talk. We do this every single week, as the name implies, at 8:30 a.m. Mountain Daylight Time. Mountain Standard Time's coming soon. Yeah, about another month or so. Anyway, good morning. The topic this week is a year-end medical tax practice tip. Did I say that right? A year-end medical practice tax tip. I'm so sorry. We are broadcasting live from the road. A little bit of trivial information. We happen to be in Chimney Rock, Nebraska today. So, good morning, everyone, and welcome. I do want to, first of all, congratulate everyone who took my advice recently and made sure that you made a good estimated payment for the month of September. For reasonably accurate estimated payments throughout the tax year ensures that your tax filing that you're going to do next tax season in early 2025 is it actually something that you look forward to measure uh, your practice's metrics, as well as ensure that you're getting all the other things into your tax estimations. And by making 4 good estimated tax payments in each of the deadlines, um, you are also eliminating the possibility of paying extra money. That's right. If you're an entrepreneur, and that includes doctors, and you just basically treat tax season as a annual dental visit, something to be avoided because you don't want a root canal or whatever, you are going to end up paying hundreds or even thousands of extra dollars because you're supposed to be paying as you go. And if you're going to owe over $1,000 in tax and you don't pay, then they penalize you for it, and they have a whole mathematical thing that they do, and it's just ugly. So anyway, thank you very much. I got off on a little bit of a tangent, but estimated taxes is one of my critical points and something that I preach quite a bit because it keeps the messy room in your mind clear, but it also saves you money. So thank you and congratulations if you got that done. Now that that's over, breathe a big sigh of relief. I'll do it with you. Here we go. Okay, so that's over. It's a lot of work for our firm as well, so I'm very happy about that. And my thoughts turn to the last trimester of the year. We're already well into September, and trimesters in a year are basically 4-month chunks. I like to actually look at the year that way because when the second trimester of the year ends on August 31st, it's actually a really good time to measure your practice's performance because you do have that estimated tax payment deadline that falls usually on the 15th of September. So the last 4 months of the year can be a very busy time for medical practices, particularly if you see people that like general practices or immunologists or whatever. Basically, anybody that's dealing with the upswing in contagious diseases, the flus and the COVIDs and the like. It can be a very busy time of year coming up right now. As a matter of fact, I'm thinking about getting my own vaccines. So with that, it's probably not the worst idea in the world to think about ways to save money on taxes. And I had a really good thought, and I'd like to go ahead and share with you here. So the year-end medical practice tax tip, you may have actually seen this if you get on social media or other sources, or perhaps talking to your peer group. But there's this undercurrent of thought, and it comes up once in a while. If you decide to buy something big and new and shiny for your business near the end of the year, it's a tax strategy because anything that you purchase is a write-off, and it will reduce your net income. And all that is true, but you need to approach this with caution and a little bit of planning and intelligence. It's not an automatic go-to. I made sure I put that in great big bold letters there. But if you do it right, this is actually can be a very good strategy for you. So yeah, let's see. Here we go. One thing to consider is that depreciation can be taken in one of several different ways. And let me go over these. I've actually written, I can remember and spell it out for you here. So most diagnostic equipment like computers and other things of this nature have what the IRS calls a 5-year life. So Um, the first year is 20%, and I'll explain this. If you've ever heard the term double declining balance, it's a method for depreciating something so you're writing off more of it while it's newer. And then as its life progresses, you write off a little bit less and a little bit less each year. But the first year, you have to do this thing called half year convention. So you end up actually writing off exactly one fifth. It should be 40%, but you have to do half of that. Because if you buy it anywhere between January 2nd and December 30th, they basically consider it as though you purchased it on July 1st. So um, you can do that. And then the following year, let's say you got $1,000. I can probably do this in my head. $100,000. Let's be reasonable, something expensive that you need. So you would be writing off, of course, 20,000 of that in the first year. That's going to leave a balance of $80,000 for the next 4 years. So divide 80 by 4, and you have 20,000. So in the next year, you write off $40,000. There's your double declining balance. And then in the third year, since you've already written off $60,000, you have 40,000 remaining, 3 years to go. I believe that is going to be about $13,333 in the third year. That's the way that goes. Okay. So I'm just kind of doing those calculations quick in my head. Matter of fact, no, that's right. 13,333, I believe is correct. Anyway, yes. So the second method, bonus depreciation is still in the tax code. That's left over from the Tax Cuts and Jobs Act. That was actually going to sunset around the time of COVID, but then COVID did hit and they extended it for a while. But it's been declining for the last couple of years. So we still had 100% in 2022, 80% last year. And you get to write off anything. You can write off 60% of an asset in its first year of putting it in service this year. So that's something to consider. If you've got a lot of extra income and you want to give yourself a good tax break, you could write off 60,000 of that $100,000 X-ray machine or whatever it is in the first year. And then, of course, you would double declining balance the remaining 4 years, but it would be considerably less. So see how these things have an effect on each other. If you take a very big break in the first year, you have to micro forecast forward a few years and realize that your depreciation expense is going to be considerably lower in the future. And number 3, there's actually a bit of the tax code that as long as you have made under a certain amount, I'm sorry, not under, you have to not use this depreciation method to create a net loss. So if you made enough money to cover the entire expense of the asset and you don't write off more than, I think it's like $1.16 million, which most people are not in danger of, then you could in fact actually write off the whole 100,000 in the year that you buy it. So that's another thing you can do as well. So let me give you a couple of quick tips here and I'll wrap up. So one thing is you want to make sure that you are actually putting the asset into service in 2024. This is important. If you decide to go out and buy it the day after Christmas and you don't take delivery on it until January 3rd, and that's when you start using it, then guess what? You are putting that asset into service in 2025. It's not the purchase date. It's the actual placed in service date. So make sure that you're keeping an eye on that. And make sure that you get expert help. If you have any questions at all, there are people like me out here, including myself, by the way. If you have any questions about how this all works, get the help that you need. You're an expert clinician, and you spent 10 or 11 years going through residency and getting all that education so that you could help people with something extremely important. Nobody expects you to be a financial wizard, okay? And make sure that you're making win-win decisions. You don't want to buy something just because you want it and hope that it's going to be a good write-off for you. Going back to the previous thing I said, if you are getting the expert help that you should be, then you can ensure that you're getting the best yin-yang effect for the purchase that you're making, and that you are not only receiving the tax benefit, but you're also buying something that has a value to your practice. So, with that, I'll go ahead and wrap up for this week from Chimney Rock, Nebraska. Let me go ahead and I will do this and leave you with this thought. If you have a chance today, do something randomly kind for a stranger. Have an amazing rest of the day and an awesome weekend. And we are going to be taking a week off next week because we're going to be in the middle of a place with no technological service. So we will see you 2 weeks from today on October 3rd at 8:30 Mountain Time. Remember, that's 7:30 on the West Coast, 10:30 on the East Coast. Until then, have an amazing couple of